On October 19, 1987, the stock market fell 22% in a single day. Not over weeks or months. In one trading session. The Dow Jones Industrial Average lost 508 points, wiping out $500 billion in wealth before the sun set. It was worse than any single day of the 1929 crash. Worse than anything in recorded financial history. And here's what made it truly terrifying. There was no reason for it. No war had been declared. No banks had failed. No economic data had collapsed. The crash was caused by machines. Computer programs designed to protect investors had turned into a doomsday device that nearly destroyed global capitalism in less than 7 hours. But here's what matters right now in December 2024. The machines are back, except now they're 1,000 times faster and infinitely more sophisticated. Artificial intelligence controls 80% of all trading volume in American markets. High-frequency trading firms execute trades in microseconds, faster than any human can perceive, let alone react to. The average holding period for stocks traded by algorithmic systems is 22 seconds. 22 seconds. These aren't investors making decisions. These are machines making calculations. And when those calculations align toward selling, when the algorithms all decide at the same moment that risk is too high and safety is paramount, the next crash won't take 7 hours like 1987. It will take 7 minutes. Based on every market structure analysis and every historical parallel to 1987, we're approaching a moment in late 2025 or early 2026 when algorithmic trading will trigger a cascade failure that makes Black Monday look like a practice round. The infrastructure for this crash is already built. The leverage is already deployed. The algorithms are already programmed. The only question is what triggers them and whether you're positioned to survive and profit when the machines panic. Because in 1987, the investors who understood what was happening, who recognized that computers were driving the selling and that the selling was self-reinforcing rather than fundamentally justified, those investors bought aggressively during the panic and made fortunes over the following years. This isn't history for context. This is the immediate blueprint for the greatest buying opportunity of your lifetime. The 1980s were a period of financial innovation that changed markets forever. After the brutal recession of the early decade, the American economy had rebounded strongly. Interest rates had fallen from the Volcker highs of 20% to more manageable single digits. Corporate profits were growing. The stock market had been climbing steadily since 1982, posting gains year after year. By 1987, the bull market was 5 years old and investors were convinced it would never end. But beneath the surface, something new and dangerous was taking shape. Wall Street had discovered computers. Not just for record-keeping or back-office operations. For trading. For making split-second decisions about buying and selling based on mathematical models that most people couldn't understand and very few people questioned. The innovation that would cause the crash was called portfolio insurance. It was sold as a way to protect institutional investors from market declines. The concept seemed elegant. If you owned a large portfolio of stocks and wanted to protect against losses, you could use this computer program to automatically sell stock index futures when the market fell. The selling would hedge your position, limiting your downside. If the market fell 5%, the program would sell futures contracts. If it fell 10%, it would sell more. The more the market dropped, the more the program sold. It was mathematical insurance against catastrophic loss. Except it had a fatal flaw that nobody had seriously considered. The flaw was simple and devastating. Portfolio insurance only worked if a few investors used it. If everyone used it simultaneously, it became a doomsday machine. Think about the logic. When markets fall, portfolio insurance programs start selling. That selling pushes markets lower, which triggers more portfolio insurance selling, which pushes markets even lower, which triggers even more selling. It's a self-reinforcing cascade with no natural stopping point except complete collapse or someone stepping in to break the cycle. By October 1987, portfolio insurance had become enormously popular. Institutional investors controlling hundreds of billions of dollars had implemented these programs. They were all using similar models. They would all trigger at similar price levels. And nobody had stress-tested what would happen if they all activated at once. The week before Black Monday had seen declining markets. Nothing catastrophic, but steady selling that made investors nervous. On Friday, October 16, the market fell more than 4%. Not enough to cause panic, but enough to activate some portfolio insurance programs. Those programs began selling stock index futures, which put additional downward pressure on prices. Over the weekend, investors had time to worry. They read the headlines. They looked at their portfolios. They made decisions. And on Monday morning, October 19, when trading opened, the selling began immediately. Within the first hour, the market had fallen 2%. Portfolio insurance programs kicked in, adding billions in sell orders. The market fell 3%. More programs activated. 4%. Even more programs. 5%. By mid-morning, human traders on the floor of the New York Stock Exchange were overwhelmed. The sell orders were cascading faster than they could process. The systems that connected markets, the computers that were supposed to make trading more efficient, were breaking down under the volume. Stock prices on the exchange floor were minutes behind the prices being displayed on screens. Investors didn't know if they were buying at $50 or $45. The uncertainty created more panic. More selling. The specialist system that was supposed to provide liquidity, where designated traders were obligated to buy when everyone else was selling, collapsed. The specialists didn't have enough capital to absorb the wave of selling. Many simply walked away from their posts, refusing to fulfill their obligations because the losses would have bankrupted them. By noon, the market was down 15%. Portfolio insurance programs were now in full panic mode, selling everything they could as fast as they could. But here's where it got truly catastrophic. The futures markets in Chicago, where portfolio insurance programs were dumping their positions, had fallen even more than the stock market in New York. This created what's called a basis spread. Futures were trading at huge discounts to the actual stocks. Arbitrage traders, seeing this gap, should have bought the cheap futures and sold the expensive stocks, bringing the markets back into alignment. But the systems were so overwhelmed and the panic was so severe that this normal mechanism failed. The gap widened instead of closing. Which meant futures kept falling faster. Which meant portfolio insurance kept selling more. Which meant stocks kept collapsing. Human intervention was impossible. The computers were making decisions faster than humans could react. By the time a trader recognized what was happening and tried to place an order, prices had already moved. The machines were operating on microsecond timeframes while humans were operating on minute timeframes. The mismatch was total. By the close of trading, the Dow had fallen 508 points, a 22.6% decline. It was the largest single-day percentage drop in stock market history. Larger than any day in 1929. Larger than anything that had come before. $500 billion in wealth had evaporated in 7 hours. And the terrifying thing was that nobody knew if it would continue the next day, or the day after, or if the entire financial system would simply collapse under its own weight. That night, financial leaders around the world held emergency meetings. The Federal Reserve Chairman, Alan Greenspan, made it clear the Fed would provide unlimited liquidity to prevent a complete meltdown. Major banks agreed to continue lending. The system held, barely. Trading on Tuesday was chaotic, but the market stabilized and then rebounded. Within 2 years, the market had recovered all its losses and continued climbing. But the lesson of Black Monday should have changed everything. It didn't. What it should have taught was that allowing computers to make split-second trading decisions without human oversight or circuit breakers was insanely dangerous. That interconnected algorithmic systems could create cascading failures that humans couldn't stop. That speed and efficiency were wonderful until they weren't, and when they weren't, they could destroy everything in minutes. Instead, what actually happened was that markets installed circuit breakers, automatic pauses in trading if markets fell too far too fast, and then went right back to algorithmic trading but with even more speed and complexity. Now here's where this becomes critical for you right now. The 1987 crash was caused by primitive computer programs executing simple if-then logic. If market falls X%, then sell Y contracts. That was the extent of the artificial intelligence. Today, actual artificial intelligence, machine learning algorithms that adapt in real time, control 80% of all trading volume. Let that sink in. 80% of every share traded, every option purchased, every future sold is being decided by algorithms operating faster than human perception. High-frequency trading firms, the modern equivalent of portfolio insurance, can execute trades in 300 microseconds. That's 3/10,000ths of a second. They can detect price discrepancies across markets, execute arbitrage trades, and exit positions before a human trader can even see that an opportunity existed. The average holding period for stocks in high-frequency trading portfolios is 22 seconds. They're not investing. They're not analyzing fundamentals. They're extracting microscopic profits from tiny price movements millions of times per day. And here's the terrifying parallel to 1987. They all use similar algorithms. They all optimize for similar objectives. And they'll all reach similar conclusions at similar moments when markets become unstable. The data on current market structure should be keeping regulators awake at night. Algorithmic trading accounts for 80% of volume, up from essentially zero in 1987. High-frequency trading specifically accounts for 50% of all equity trading volume. The 10 largest quantitative hedge funds manage over $1 trillion using algorithmic strategies. Derivative markets, which amplify and accelerate price movements, have notional exposure exceeding $600 trillion. The interconnectedness is total. The speed is overwhelming. The complexity is beyond human comprehension. We've built a financial system that operates faster than human reaction time, using logic that humans can't fully audit, with interconnections that humans can't fully map, and leverage that humans can't fully contain. Flash crashes have become routine. In May 2010, the market fell 9% in minutes, erasing nearly $1 trillion in value, before recovering most of it within the hour. Nobody could explain it. Algorithms had triggered algorithms in a cascade. In August 2015, the market opened with wild price swings that halted trading in hundreds of stocks simultaneously. Algorithms couldn't determine fair prices because other algorithms weren't providing liquidity. In March 2020, at the start of the pandemic, markets experienced daily swings of 5 to 10%, volatility that would have been unthinkable before algorithmic dominance. Circuit breakers triggered multiple times. Trading was halted repeatedly. The machines were panicking faster than humans could intervene. And here's what makes the next crash inevitable and terrifying. The algorithms are getting smarter. Modern AI doesn't just follow programmed rules. It learns. It adapts. It identifies patterns humans can't see. It makes predictions based on millions of variables. And it does all of this at speeds that make 1987's portfolio insurance look like a sundial. When these algorithms decide simultaneously that risk has become too high, when their machine learning models all reach similar conclusions about market instability, the selling will be instant, overwhelming, and unstoppable. Circuit breakers will trigger. Trading will halt. But when trading resumes, the algorithms will still be there, still executing their logic, still driving prices lower. Now let's map the timeline based on every market cycle pattern and every structural fragility currently visible. Right now through the second quarter of 2025, we're in the confidence phase. Markets are hitting new highs driven by artificial intelligence hype. The Magnificent Seven tech stocks continue dominating returns. Volatility is low. Investors are complacent. This is exactly how 1987 looked in the first 3 quarters of that year. Strong gains, low volatility, broad confidence that the good times would continue. But beneath the surface, leverage is building. Algorithmic strategies are crowding into similar trades. Correlation between assets is increasing as more algorithms make similar decisions. The structure is becoming fragile even as the surface looks calm. The third quarter of 2025 through the first quarter of 2026 is when the structure likely breaks. This is when some external event, it could be geopolitical, it could be economic data, it could be a corporate bankruptcy, doesn't matter what specifically, triggers enough selling to activate the algorithmic cascade. It won't seem like much at first. A 3% decline. Some profit taking. Routine volatility. But that 3% decline will trigger risk management algorithms to reduce exposure. That selling will push markets down 4%. More algorithms will trigger. 5%. Even more. 6%. Circuit breakers will halt trading. But the algorithms don't sleep. They don't panic. They just calculate. And when trading resumes, they'll still be selling. 7%. 8%. 10%. By the time humans realize what's happening and try to intervene, the cascade will be self-sustaining. The 1987 crash took 7 hours. The 2026 version will take minutes for the initial collapse and days for the full destruction to play out. The second quarter of 2026 through year-end is the recovery positioning phase. Just like 1987, the market will stabilize after the crash. The Federal Reserve will intervene with emergency rate cuts and liquidity provisions. Major institutions will pledge support. Circuit breakers will be adjusted. New regulations will be proposed. And the market will recover because the crash wasn't about fundamental economic collapse. It was about algorithmic cascade. The companies that were worth X before the crash will still be worth X afterward. But in the interim, they'll have been trading at 50 or 60% of X. That's your buying opportunity. That's when assets go on sale not because they've become worth less but because machines temporarily broke the pricing mechanism. So what do you do? Here's exactly how you position before the algorithms panic. Step 1 is building a 40 to 50% cash position by the third quarter of 2025. This goes against every instinct when markets are hitting new highs and artificial intelligence stocks are soaring. But you're not trying to beat the market in the short term. You're positioning for the event. Put this cash in treasury money market funds or short-term treasury bills. You want maximum safety and instant liquidity. When the cascade hits, this cash becomes your ammunition. Step 2 is identifying quality companies that will be unfairly punished during the algorithmic cascade. The machines don't distinguish between good businesses and bad businesses during panic selling. They just execute. Find 20 to 30 companies with strong balance sheets, consistent free cash flow, essential products or services, and global diversification. Technology companies that generate actual profits, not just growth. Healthcare companies with recurring revenue from essential drugs or services. Utilities that provide power regardless of market sentiment. Energy companies benefiting from long-term supply-demand imbalances. Consumer staples that people buy during good times and bad times. These companies will be swept down with everything else during the crash. That's when you buy them. Step 3 is understanding that traditional diversification fails during algorithmic cascades. In 1987, everything fell together. Stocks, bonds, commodities, all crashed simultaneously because the machines were selling everything. The only assets that held value were cash and short-term government securities. In 2026, the same will happen. Your traditional 60-40 stock bond portfolio will fall 50% because algorithms don't care about your allocation theory. They're programmed to reduce risk across all correlated assets. The only diversification that matters is being in cash before the cascade and deployed into quality during the panic. Step 4 is recognizing that you cannot time the bottom. Don't try. The machines will overshoot to the downside just as they overshoot to the upside. Instead, deploy capital in stages. When the market is down 15% from recent highs, deploy 10% of your cash. Down 25%, deploy another 15%. Down 35%, deploy another 15%. This ensures you're buying progressively cheaper while maintaining reserves in case the algorithms drive prices even lower. After 1987, investors who bought during the crash made extraordinary returns over the following decade. Not because they caught the exact bottom but because they had capital to deploy when the machines created irrational prices. Step 5 is understanding that the recovery will be faster than historical crashes because the cause is algorithmic, not fundamental. After 1929, the recovery took decades because real economic damage had occurred. Banks failed. Businesses closed. Unemployment spiked. After 1987, the market recovered within 2 years because no real economic damage occurred. It was purely a market structure failure. After 2026, the recovery will likely be even faster as authorities and market makers act quickly to restore function. But the buying opportunity will be brief. A few days to a few weeks at most. You need to be positioned to act immediately, which means having cash ready and a watch list prepared. Here are the specific signals to watch that will tell you the cascade is approaching. Signal 1 is the VIX Volatility Index. Currently trading around 13. When it spikes above 30 and stays elevated for more than a few days, it means options markets are pricing in significant stress. This typically precedes crashes by 30 to 60 days. Start moving to higher cash allocations. Signal 2 is high-yield credit spreads. currently around 400 basis points. When they widen beyond 550 basis points, corporate debt markets are freezing. This means credit stress is spreading beyond stocks. Final preparations should be complete. Signal 3 is the correlation coefficient between stocks. In calm markets, stocks move somewhat independently. Different sectors perform differently based on their specific drivers. As algorithmic dominance increases and cascade risk rises, correlation approaches 1. Everything moves together. When the average correlation between S&P 500 stocks exceeds 0.7, measured over 30 days, it means algorithms are overwhelming fundamental factors. The structure is fragile. Signal 4 is exchange-traded fund flows. Algorithmic traders use ETFs heavily because they're liquid and easy to trade. When you see multiple days of extreme outflows from broad market ETFs while individual stock prices haven't declined proportionally, it means algorithms are getting defensive. The selling is beginning. Signal 5 is the gap between futures and cash markets. Remember 1987? Portfolio insurance sold futures, creating a huge gap between futures prices and actual stock prices. When S&P 500 futures trade at discounts exceeding 1% to fair value for more than an hour, it means algorithmic selling is overwhelming arbitrage mechanisms. The cascade may be starting. Track these 5 signals daily starting in the third quarter of 2025. Create alerts so you're notified when thresholds are crossed. The signals won't all flash simultaneously. They'll cascade over weeks, giving you time to finalize positioning. Your 90-day action plan starting right now must be specific. In the next 30 days through January 2025, audit your current portfolio. Calculate exactly how much is in equities, bonds, alternatives, cash. Most people have no idea. They have vague notions but not precise numbers. Get precise. Open a high-yield savings account or treasury money market if you don't have one. Begin moving 10% of your portfolio to cash. Build your watch list of 20 to 30 quality companies. Research their balance sheets. Understand their business models. Know what price levels represent genuine value. In the 60-day window through February 2025, increase cash allocation to 25%. This means selling some holdings. It might mean taking profits on positions that have run up. It might mean accepting small losses on positions that haven't worked. Doesn't matter. You're repositioning for the event. Set up tracking for the 5 cascade signals. Build a simple spreadsheet that updates daily with VIX level, credit spreads, stock correlation, ETF flows, and futures cash gaps. Color code the cells so you can see at a glance when signals are approaching danger zones. Familiarize yourself with how to execute trades quickly. Make sure you can access your accounts and place orders from multiple devices. In the 90-day window through March 2025, reach 35 to 40% cash allocation. Finalize your quality watch list. For each company, note the price you're willing to pay, which should be 30 to 50% below current levels. This seems impossibly optimistic now. It won't during the cascade. Review and practice the deployment plan. Simulate placing orders. Make sure you understand how to use limit orders so you're not buying at random prices during chaos. Run scenarios for how much capital you'll deploy at various market decline levels. Psychological preparation matters as much as financial preparation. When the cascade hits, your instinct will scream at you to sell, to preserve what you have left, to get out before it gets worse. You need to have trained yourself to do the opposite. The parallels between 1987 and now are not subtle. They're glaring. In 1987, new technology, computers and algorithmic trading, had been adopted widely without understanding the systemic risks. In 2024, artificial intelligence and machine learning have been adopted widely without understanding the systemic risks. In 1987, leverage and interconnectedness had reached levels where a small shock could cascade. In 2024, leverage and interconnectedness have exceeded 1987 by orders of magnitude. In 1987, regulators and market participants believed that markets were more efficient and stable because of technology. In 2024, regulators and market participants believe markets are more efficient and stable because of technology. In 1987, most investors had no idea a crash was possible until it happened. In 2024, most investors have no idea a crash is possible. But there's one crucial difference. In 1987, computers were following simple programmed rules. In 2024, artificial intelligence is learning, adapting, and making decisions based on patterns that humans can't see or understand. The machines aren't just faster. They're smarter. They're processing more data. They're identifying more correlations. And when they reach conclusions about risk, they act on those conclusions instantly and decisively. The 1987 crash took 7 hours because computers back then couldn't trade faster. The 2026 Cascade will take minutes because today's AI can trade at the speed of light. Literally. Trading algorithms execute in microseconds, limited only by the speed of light traveling through fiber optic cables. Think about what this means. From the first moment of algorithmic selling to complete Cascade will be faster than you can perceive. You won't have time to log into your brokerage account. You won't have time to call your advisor. You won't have time to think. By the time you realize the cascade has started, it will be over. Circuit breakers will trigger. Trading will halt. And when you finally get access, prices will be 30 or 40% lower and still falling. That's why positioning before the event is non-negotiable. That's why having cash ready and a watch list prepared is the only strategy that works. That's why waiting until you see the crash happening before acting is guaranteed to fail. The investors who profited from 1987 shared certain characteristics. They had capital available because they hadn't chased the final months of the rally. They understood that algorithmic selling created temporary price dislocations, not permanent value destruction. They acted quickly during the panic, buying quality companies at prices that seemed insane. They held through the volatility as markets stabilized. And they compounded their capital over the following decade into generational wealth. The same opportunity is approaching. The same pattern is repeating. The same strategy will work. But this time the crash will be faster, more severe, and more frightening because the machines are more sophisticated. When artificial intelligence systems managing trillions of dollars all reach similar conclusions about risk at the same microsecond, the selling will be instant and overwhelming. Human intervention will be impossible. Circuit breakers will buy minutes at most. And the recovery, while eventual and likely swift, will only benefit those positioned to buy during the brief window when the machines have broken the pricing mechanism. Right now in December 2024, conventional wisdom says you should be fully invested in artificial intelligence stocks because the revolution is here and anyone not participating is missing out. The narrative is identical to 1987 when everyone was fully invested because markets only went up and anyone holding cash was an idiot. The psychology is identical. The setup is identical. The outcome will be identical except worse. Market structure analysis shows that the infrastructure for cascade failure is more developed today than it was in 1987. High-frequency trading creates fragility because liquidity can vanish instantly when algorithms withdraw. Passive investing creates fragility because index funds don't discriminate, they just buy or sell everything. Algorithmic trading creates fragility because all the machines reach similar conclusions at similar times. Exchange-traded funds create fragility because they can trade at prices disconnected from their underlying holdings. Derivatives create fragility because they amplify price movements. The system is as brittle as it's ever been, held together by confidence and central bank promises, waiting for the moment when the algorithms decide risk is too high. The Federal Reserve knows this. They've run simulations. They've studied 1987. They've built tools to intervene. But their tools assume they'll have time to deploy them. They assume the cascade will unfold over hours or days, giving them time to announce programs, coordinate with other central banks, and restore confidence. What they're not prepared for is a cascade that unfolds in minutes. Where by the time they can even convene an emergency meeting, the machines have already executed their selling programs and triggered circuit breakers multiple times. The intervention will come. The Fed will act. But it will be after the damage is done, after prices have collapsed, after fortunes have been transferred from those who weren't positioned to those who were. Your positioning over the next 9 months will determine which side of that transfer you're on. Building cash by mid-2025. Identifying quality companies. Tracking the 5 cascade signals. Preparing psychologically to buy when terror is at its peak. Executing the deployment plan in stages as prices collapse. Holding through the volatility as markets stabilize. The playbook is clear. The timeline is visible. The opportunity is approaching. History doesn't repeat, but the patterns are impossible to ignore. On October 19, 1987, primitive computers crashed markets 22% in 7 hours. Nobody saw it coming. Nobody could stop it. Investors who understood that machines had temporarily broken pricing made fortunes buying during the panic. In late 2025 or early 2026, artificial intelligence will crash markets faster and harder than anything humanity has experienced. The algorithms that make markets efficient in normal times will make them catastrophic in stress times. The speed that creates microsecond profits will create minute-level disasters. The intelligence that identifies patterns will identify risk simultaneously across trillions of dollars of capital. And the cascade will unfold before human intervention is possible. But you see it coming. You understand the pattern. You know the signals to watch. You know the strategy to execute. The question isn't whether the algorithmic cascade will happen. The question is whether you'll be positioned to profit from it. If this gave you the exact playbook to position before AI crashes markets in 2026, hit subscribe. The machines are getting ready. The question is whether you are.